to this video lecture. In this video, we are going to describe an account and its use in recording transactions. So business transactions are the basis of the financial statements, and business transactions and events are the starting points of our financial statements. So the process from transactions to the financials is first we start with identifying the transaction and event from source documents. Then we analyze the transaction and event using the accounting equation. Assets equal liabilities plus owner's equity, or ALO. Then we record the relevant transaction in a journal. Then we post that journal to the general ledger accounts. And lastly, we prepare and analyze the trial balance, which gives us that debits equal credits. And then we prepare from the trial balance the financial statements. So source documents identify and describe transactions, and that's what we use to enter journals into our accounting information systems. So we might get invoices or bills from suppliers, we might get sales receipts, checks, purchase orders we might issue, or payroll records, or reconciling to our bank statements, are all types of source documents. So the accounts are what provides us the underlying foundation for our financial statements. So an account is a record of increases and decreases, whether it's an asset, a liability, an equity, a revenue, or an expense. And then the general ledger is a record of all of those accounts and their balances. So here we have the accounts and the types of accounts. So we start with assets, and we have cash, accounts receivable, notes receivable, inventory, prepaid accounts, supplies, equipment, building, and land. Then we have liabilities, such as accounts payable, notes payable, unearned revenue, and accrued expenses. Then we have our owner's equity accounts, common stock, dividends, revenues, and expenses. And here you see that the accounts are all organized by the accounting equation: assets equal liabilities plus owner's equity. So we have asset accounts, such as cash, prepaid accounts, land, buildings, equipment, supplies, and accounts receivables and notes receivable. Then we have liability accounts, accounts payable, accrued liabilities, notes payable, and unearned revenue. And equity accounts, common stock, dividends, revenues, and expenses. And notice that common stock and revenues both increase our equity accounts, and dividends and expenses both decrease our equity accounts. So here we see the expanded equity equation, where revenues and common stock increase equity and expenses and dividends decrease equity. Then we have the general ledger, which is a collection of all accounts and their balances and what we use for our accounting information systems. So a company's size and diversity of operations will impact the number of accounts needed. And the chart of accounts is a listing of all of the accounts, and it includes some identifying number for each account. So as you can see here, we have 101 for cash, we have 201 for accounts payable, and 307 for common stock, for example.